Okay, thank you everybody for sticking around to the last session of the day. So we have a very lively group of panelists here, so we're going to do this a little differently. We're not doing like a Q&A style, we're just going to kind of have a conversation because I know for a fact that they have really interesting views on everything. So basically, this is about kind of the future of digital money, and that's a huge topic. I want to start with kind of the theme of tokenization, digital asset tokenization, which is a huge theme of this conference and just kind of in the crypto world right now. We're hearing so much about tokenization of real world assets. And I want to sort of get into the specifics of that. Like, what does that actually mean? What are the problems it's trying to solve? So, Prady, let's just sort of start with you. We're hearing so much about tokenization, right? And it kind of reminds me a little bit, to be honest, of like 2019 era when like the market wasn't that great and everyone was like blockchain, not Bitcoin. Are we kind of going back to that era where we're trying to like do DLT and not actually cryptocurrency, or is that not a correct assessment of the situation?
Yeah, no, thanks for putting me in the spot to begin this. So yeah, essentially, I can't figure out how to separate blockchain from crypto in terms of the technology versus sort of applications. In similar vein, yes, I think there's so much discussion now on tokenization without an understanding of what context are we really referring to. And I mean, just as we track this very closely, interestingly, the narrative has been kicked off by the crypto industry, which is now looking for some form of yield assets, and therefore it's trying to take treasury instruments, a whole bunch of other instruments, and trying to put that on chain for the purposes of crypto. But in the TradFi context, actually, tokenization means completely something different. And therefore, yeah, I mean, it's taking a narrative of its own, but at the core of it, really, if you look at tokenization, we're really talking about standardization. And how do you have digital representations in standardized formats so that the asset that's represented can benefit from the functionalities of blockchain. And a simple example of that would be if I have an asset, instead of sitting in a database or locked up and with no utility, can I, as an example, cross-collateralize that for other purposes, right? So there's a whole sort of detail behind that. But yes, I think the narrative is kind of getting a mix right now, whereas I think in most cases people are talking about digitization, but they're referring to that as tokenization. I don't know if folks have other views on this.
Yeah, a lot of people, when they use the tokenization, the first thing they tell you, oh, we can fractionalize that thing. But honestly, I think that is not the point. Tokenization brings you a new way of tracking the ownership of an asset. We've had cases of clients who wanted to sell some stock from a private company, and the guy had a paper certificate. He couldn't find it. So we had to go to court to demonstrate that the guy was the owner of a chunk of that company, and end to end it took almost 18 months, right? And tokenization can help not more than liquidity, but it's something that is illiquid by nature. There's no way you can change that, but it can help with what I call mobility. I can then easily have an asset. It might be equity from a private company. I can just send it to Prady. And there is a public record that anyone can access that proves that I'm the owner, and now the owner is Prady. So yeah, that would be my take. I don't think we've identified what's the actual use case or made that clear.
And the only thing I would add, Emily, is that the false narrative or the false dichotomy of blockchain yes, crypto no. I think we would probably all wince at that. And I'm not sure the discussion we're having now in terms of tokenization of real-world assets, it's not an either-or. The blockchain is not an either-or to crypto, it's an add-on. And I think as the technology evolves and as people get more comfortable with the technology, they will think of additional use cases and applications. And I think that's where we are. It's another evolution in the journey.
Look, I think 5 to 10 years from now, by the way, nobody's going to use the word crypto or tokenization or DLT. It's just going to be a part of our modern day life. Right now, we get really caught, and a lot of regulators, I'm a former one, they get really caught on the language. The question is this a superior technology that allows you to do really interesting things with your assets, to engage in global commerce in a way that we haven't been able to do in the past? what's the functionality of smart contracts? How does it benefit you? Fractionalization is a thing. There are all kinds of ways to manipulate and engage in more sophisticated transactions and also feel like you have greater ownership if you want it and control over the thing that you own.
I do think, though, that there are some governments out there or some banks out there that are trying to do this in a permissioned, centralized way. So in that sense, it is some element of crypto, not blockchain. And the reason why this matters, I guess, is like, if you're sort of a crypto purist, I mean, it can look like not exactly what you originally set out to do. So.
Well, but I think you could have tokenization of real-world assets on a permissionless blockchain or permission blockchain. I think the JP Morgan coin probably is on a permission blockchain, not a permissionless blockchain. And that's a digitization of a real-world asset. So again, in your question, you see, I know you're trying to provoke or a sort of dichotomy, this either or. I don't see it as an either or.
Yeah, well, no, I'm not trying to provoke. I actually really think that.
I know.
Yeah.
But I'll let you provoke me on this one, right? So it's okay. So I think if you actually speak to any of the FIs, they're not going to be telling you, I mean, the more informed ones, right? They're not going to be telling you about the issue with the technology per se. For them, it's about what gets them regulatory clearance. And from a regulatory clearance perspective, what they need to solve for is ensuring privacy and a whole bunch of other considerations where there's a pathway, right? So yes, we need ecosystems that are completely open, so on and so forth. But I don't think the regulators are there today in getting the necessary comfort, quite rightly, on the fact that, yes, all these functionalities are fantastic, right? So we talk about programmability, composability, and a whole bunch of things. But when it comes to, for example, privacy, being able to meet all the sanction screening requirements, so on and so forth, right? We need to have a privacy layer on top, and then customers can make the choice. If a customer wants to use an unregulated stablecoin, beyond a point, regulators can't do anything about it. They can only issue warnings, right, as they're rightly doing. But if a customer actually wants to work in some sort of a permission context, that's the customer's choice, right? So I think there's a pathway here. And Fernando, I know you guys have a pretty strong point of view on this one.
Yeah, I think we, as an industry, have a narrative issue because we keep saying that this, tokenization technology is disruptive, it's revolutionary. I would argue that is not the case. This is part of the evolution of capital markets. The digitalization journey of finance started in the 60s with mainframes. And then we've seen a move to open architecture systems, the internet, cloud computing, you name it. I'm pretty sure that people in the 60s were crazy when IBM started telling people, oh, by the way, you don't need this piece of paper anymore. You're going to be building a CSD, and they're going to use a database, whatever that is. And I honestly see this technology as part of the digital transformation journey of finance. And so I think we should be very careful with the way we do the pitch to certain stakeholders like regulators who might be, frightened by the.
Yeah, I think part of the problem, the permission versus permissionless, I think regulators understand how to regulate in a permissioned environment. So it feels safe and comfortable for them because it's similar to what we have in traditional finance. Permissionless, it's just a little harder to wrap your head around it, right? And if it's something that you're not familiar with, and by the way, most regulators around the world actually aren't allowed to interact with the technology, and by the way, they still don't understand how do you do AML, CFT, how do you make sure bad actors don't get access and use the ecosystem to do bad things, how do you keep things safe and secure, et cetera, et cetera. Until they feel like those kinds of problems can be solved for in a permissionless world, they're not going to be comfortable with it. My view is actually we're going to solve for all of those problems, permissioned or permissionless, because as long as you have really smart developers who are motivated to solve for difficult and complex problems, you're gonna get there. But until they can kind of wrap their head around what this even means and how they control it, how they can control bad things from happening with it, it's going to be a longer.
I've argued that this permissionless word is a bit of oxymoron, because at the end of the day, you can always build an identity overlay on top. a privacy overlay. Actually, just this morning, I think it was, UBS, DBS, and us, we announced the results of Project Guardian. And we did the first ever live Ribbit transaction using a public blockchain. And trust me, when we developed this smart contract, no one else had access to that because we implemented this identity overlay on top. Not only that, actually it was easier to convince the regulators than our internal stakeholders. Because the MAS happens to be pretty sophisticated, so we are kind of lucky. But internally, the SBI's head of risk, DBS's head of risk, they didn't get it. So we need to define risk controls around it and stop focusing on public blockchains. Again, I would argue that this permissionless thing is a misnomer because we ended up deploying something that was a private smart contract on a public blockchain. So you get the best of both worlds. You can implement the risk controls that you need, but it's also easy to deploy. So operationally speaking, you get a lot of savings. So I think that's the holy grail. And again, I think we need to change the narrative and the optics, where optics matter, so that you don't scare people away.
Yeah, I think Sigal touched on an interesting point, though, about how from a regulatory perspective, they don't really understand the concept of permissionless. But I would even take it further than that and just say, like, in general, a lot of people just don't see the use cases for any of this at all, right? And I think that's one of the biggest problems in the United States is that people just, like, they don't really see any of this stuff being used. And, as a result, they see it kind of as a speculative instrument. And that matters because, members of Congress are elected. And if their constituents don't see a point, then members of Congress don't see a point. So, now we're getting into like the next level here, tokenized bank deposits and tokenized treasuries and tokenized everything. It's getting even a little bit more, next level. And it's like, I guess my question is like, do you think people really understand the need for this, or are there real life use cases for this? Does it matter? Like how the issue here is all mainstream adoption. It's all about mainstream adoption, right? And some argue that like, crypto hasn't even really gotten there. So is this sort of next level that we're talking about now, how far are we from like getting people to really see why this is necessary?
Yeah, so I would argue that the narrative is the narrative. I don't think it matters beyond a point, because if you even track Singapore FinTech Festival and a number of events over the years, there's a very distinct shift away from concepts to POCs to things actually going into production. And actually, MD Ravi said it well in one of the roundtables. It's now about scaling, right? Where at least we take comfort in what we're observing is that you now have a critical mass of relevant institutions, relevant sort of end customers who are beginning to use it. And as with everything else, and I said this at the Token 2049 main stage as well, which is the first real application is coming in the context of tokenized money. That is the most foundational piece, which is tokenized money. And crypto, by the way, led with it, but was not for mass market usage. But now if you think about just tokenized money and regulated stablecoins plus actually taking fiat solutions and bringing all those features, Sigal, that you keep speaking about around programmability, so on and so forth, that going into production now, right? So you would have seen announcements out of Finality yesterday on the investment round. There's other stuff that's gone out of Singapore, like Partior, so on and so forth. These things are now going into production. I'll give you a very specific example. There's a German company now which is demanding programmability from the banks. So as we speak to them, it's not now about banks and regulators. This is actually end customers saying, the treasury teams are saying, I need these functionalities. So then there's two banks who are already providing that. Then they're going to the third bank and saying, I need that. So that's how the real use cases are coming. And if you ask me, the prediction would be the same thing will happen with capital markets. It just take longer because that's much more fragmented, much more complicated. But you start with sort of money, you go to that, and then the crypto world will anyways do things around gaming, so on and so forth, which sort of comes together.
Yeah. No, I agree with everything that Patty just said. Also, here's an issue with the U.S. If you're not most regulators in the U.S. federally are not allowed to interact with the technology. It's like prohibited. If you have anything to do with crypto policy, you cannot use the technology. It's basically like regulating with a blindfold on. If you can't use the technology, of course you don't understand the use cases. You're not interacting. You're not seeing it. You're not using stable coins to transfer value. You're not thinking about it took less time for me to send money from point A to point B than it did with my bank, because you're not even allowed to do that. But a different question is, why does it matter, right? So why does a particular, and again, I'm a former regulator, so I can say these things. Why does it matter for a particular regulator to understand what the use case is? We've always allowed innovation to happen. This is what capital markets, venture, et cetera, is all about. So I almost think the conversation about, is there a use case today that's going to enable mass adoption, is sort of beside the point, because what we want to allow for, there are enough developers, there's enough venture money, put into this ecosystem that it must matter for something really interesting and exciting. And this whole notion that we have to prove today exactly what use case is going to matter 10 years from now, if that was the case, it would be a massive obstacle for any large-scale the Industrial Revolution, right? I mean, you could have made that argument a long time ago.
I love the fact that you focus on two different stakeholders. Actually, when it comes to capital markets, there are many more. You have your issuers, have rangers, broker-dealers, prime brokers, custodians, the actual investor at the end of the chain. And each of them have their own data transformation roadmap. If you're a bank, you might move pretty slowly, right? If you're a regulator, maybe it's even slower. But the broker-dealers, they want to sell more, right? So they are more willing to take risks. So I think that is the issue that we are having. There's a misalignment in the digital journey of all the different stakeholders, and that's what is creating all this friction. And that's what was one of my key learnings in Project Guardian. Because in some cases, we, the banks, the sales side, we're ready. When you reach out to the asset managers, sovereign funds, you name it, they tell you, oh, we are not ready. Why don't you come talk to us 5 years down the road?
Yeah, I think.
Yeah,
Go ahead.
the only thing picking up on these comments, if you have to prove the promise of the technology before you can build the technology, you'll never build anything. If you asked Bill Gates in 1996, and he was asked, why does everybody need a personal desktop computer? He didn't have a good answer. And if you ask somebody 25 years ago, why do you need a digital representation of your stock certificate? They would probably say, I don't, because I like the stock certificate in my safe. So I think if you think about tokenization of real-world assets in traditional finance, that's going to be a different topic. If you think about tokenization of real-world assets for collectibles, for art, a little bit easier to get your head around. And then there are just inefficient markets, carbon credits, it's just not transparent, to be polite. And could they be improved through tokenization, right? So each one of those buckets may be easier to envision than others, but again, to Sigal's point, if you have to kind of prove the promise of the technology before you can build the technology, we would never build anything.
By the way, I want to say also, and then we're talking about all this and sort of criticizing how regulators are looking at it. I actually, and I'm not saying this because I'm in Singapore, I talk to people about Singapore all over the world. I think the fact that here in Singapore, you have a central bank that is actually engaged in experimentation and understands, like Project Guardian, and understands that through that experimentation, by the way, with traditional players, they're going to learn, the entire ecosystem is going to learn, they're going to think about how to build standards. That's a pretty remarkable thing. In my opinion, what MAS is, what Singapore has really fostered. Because they know they don't know all the answers.
Yeah. So I'm actually glad you called that out, because the only clarificatory point I'll make is, as much as I agree, they can't always articulate the benefits of a technology. If you try to explain TikTok and self-generated content like 10 years back, people would think you're crazy. and there you go, right? It's a very useful application, or widely used application.
Yeah, I mean, obviously I can speak about I mean, I spent a ton of time in Asia, but just speaking about it also from a US perspective, I wouldn't say that the fact that people don't really see the use case in the US is totally irrelevant. It is relevant because the US is actually running pretty active interference, as Stuart knows very well. You know, it's pretty hard to do crypto right now in the United States. And I think part of the reason, not the entire reason, but part of the reason is because regulators, Congress, and the average American person, the headlines they're seeing is FTX collapses, Sam Bankman-Fried is going to jail. You know, they're seeing stuff like that. They're seeing the negative headlines, and they're not really seeing the positive part. So I just want to kind of clarify that. I don't think it's like totally irrelevant.
No, so, but I will, again, in our work, as we work to put some of these things into production, I can tell you a meaningful number of parties that are engaged are American institutions. See, this is where, I know there's a broad narrative, but I don't think the number of institutions who are actually domiciled in the US, what they're coming and telling us is, yes, today they don't have the right frameworks in the US, but what they're doing is, and it's not just Singapore, by the way, obviously Singapore is doing a fantastic job, and it's great to hear from all of you visiting Singapore, but Hong Kong, right? You look at the Middle East, right? There's a number, now London. There's a lot of centers who are doing the work. So interestingly, just on the American lens, is that what we are observing and finding is that a lot of the liquidity obviously sits with American institutions or American systems. A lot of that innovation they're doing now outside the US with the hope of then convincing the US regulators.
Right, but they kind of have to go around is what I'm saying.
So I mean, that's
it's like in spite of,
that's
you know?
unfortunate, and you know, it is what it is, but that's what we are observing.
But that's the fascinating piece about a jurisdiction, a country like Singapore. Actually, the U.S. banks can come here, they can build in a safe environment, they can prove out certain use cases and take those, you know, ideally take those models back home. Sorry, not
So
to.
I would like to share a water story, if you don't mind. So last year, when we joined Project Guardian, we did so out of Singapore because the Japanese regulator wasn't quite ready. They tend to be followers as opposed to leaders. And the fact that we did this with Singapore last year and it was super successful, you know, we didn't lose any money for JP Morgan and DBS, who were our partners, gave us a track record that we can show not only to regulator, but also the internal stakeholders, you know, the board, the risk committee, you name it. So having someone like the MAS, who's allowing us to do that kind of things, because of what we call the trust component, it helps me with my own internal pitch. Again, I think I can go to FSA, I can go to FEMA, FCA, and you can and tell them, look, we've done it in Singapore. Our partners were JP Morgan, DBS. Not only that, we built all the legal framework and risk control that we needed to convince our own internal stakeholders. We keep blaming the regulators, but in many cases, it's the bank itself that it stops you from doing certain things. So I think the magic ingredient that was kind of missing is trust. And I think the MAS has helped a lot in the context of Project Guardian.
And in the U.S., I mean, you know, we have a problem with politics and power being elevated over sound policy. And yes, you go to the Hill, you go to Congress, they want to see the use cases. And you're absolutely right, Emily. We can't ignore the question. I think we do have to explain and educate. But 3 or 4 years ago, when I traveled the world and I talked to other regulators, I don't know if you've had similar experiences, what I was sort of told, either expressly or implicitly through body language, is we're waiting to see where the U.S. is going to go with this. Now, when they have these conversations in 2023, the impatience has crossed the line, the U.S. has fallen behind, and countries like Singapore, Dubai, London, the EU through MiCA or MiCA, everywhere else, they understand that the technology is here, it's not going away, and we can't prohibit it, so we have to sort of rationally regulate it. So I do think the U.S., although it's a very important market, it's a market we can't ignore. The rest of the world has kind of moved on in the conversation.
Maybe adding to that, I think it's going to take a while for the U.S. to catch up, because becoming a thought leader does not happen overnight. I know the likes of the MAS have been working on this for maybe 5 years plus, and you cannot build the knowledge, know-how in a year. It's going to take much longer. That's my take. So I would argue that not all the regulators are made equal. So,
but I would debate that a little bit, right? And I can't believe I'm sitting here defending the U.S. anyways. So I would debate that a little bit and say, I think US in many ways has decided it's not the one sending rockets into space and a whole bunch of other stuff, right? I do think, again, I'll say this, from a private sector perspective, innovation is live and kicking in this space in the US, unfortunately with a lot of constraints. I mean, to their credit, I mean, like you said, Project Guardian, right? The first issuance actually out of Project Guardian, thanks to the MAS, came out of Singapore with UOB, right? With HSBC, which is, arguably Asian European Bank, and then MarketNode, one of our ventures. But then, at the same time, which was not publicly known, that the US actually approved the participation of one of the large FIs on a new blockchain-based payment network. Now, they just, they don't publicize it. Yep. But in that period, and this is post Silicon Valley Bank collapse, right? So what I'm saying in this is that the fact is that overall, I think the US regulators, in our experience, are being guarded, and it is the hub of innovation. Luckily, private sector innovation in the US is live and kicking. In fact, if I just use FIs as a proxy, and if I pick the top 5 FIs globally, and we look at state of readiness, I do think the US institutions are on the margins, probably a little bit more ready than the European institutions and the Asian institutions, right? So again, I don't think all is lost in the US, and I'll stop defending the US from here on, right, and move on to the next topic.
No, you're welcome.
So I have to say also, because I was from the Treasury Department, and actually the US was the first regulator in this space. In 2013, FinCEN, which was one of the entities I used to supervise, met with a bunch of exchanges. They said, hey, this looks an awful lot to us like money transmission, so we're going to regulate you like you're a money service business. And no other country in the world was doing that. When I came in 2017, there was the US, Japan, and Australia, the only 3 countries in the world that had an anti-money laundering ecosystem, regulatory system for crypto. And what did we do? I said, well, that seems dangerous to me because bad actors are always going to go to jurisdictions where there are no rules. And so we had the presidency of FATF, and we pushed through FATF to have much broader anti-money laundering rules all over the world. Illicit finance in crypto has, with the exception of fraudsters, illicit finance has really actually gone down. So I think the U.S. is not, in some respects, the U.S. has been ahead of most other jurisdictions, and I think it will certainly catch up. I mean, I'm still optimistic, and as you said, there are a lot of amazing companies in this space that are operating out of the US.
Actually, I would argue, unless you let tier 1 financial institutions like JP Morgan, UBS, and us actually do it, they don't know what they do not know. Because during the course of Project Guardian, we've seen operational challenges that you are not quite aware of, right? And unless you let a big player actually do it,
my point is it'll happen. It'll happen. It's just a matter of time.
So I want to expand this a little bit because this is a smart panel, and as you know, there's like a lot of hype in this industry. It's so annoying, everyone's always hyping something or other, right? So I guess my personal opinion, as I just said, like one of the pain points in this industry I see is like the lack of mainstream adoption, the fact that a lot of people don't understand what the point is, the lack of real use cases. If some of you seem to agree with that to various degrees, some of you don't. But like, what in your view are the real pain points then? If it's not those, like what do you see as the major pain points right now in this industry?
Yeah, I mean, just my head is turning white faster than Fernando now. Just trying to get these networks together. And if you ask me, one of the biggest pain points is the fact that I think the market participants understand the benefit of the technology. I don't think the conversation any longer is about what's the benefit of the technology. And I'm talking about the full value chain. I'm not just talking about the large FIs now, right? You look downstream. It's the fact that you're running large existing systems, which are not broken in the context of what they're trying to deliver today. They're not broken. I mean, a lot of people like to say everything is broken. It's not broken. But you have these completely new set of functionalities that everyone needs to enable. So how do you prioritize this? The cost of actually running maybe 2 systems for a while, the disruptions that come with that, the operating risks that come with that, right? So I think we're at that phase now finally where people are not thinking about, how do we implement these in our environments, get the regulators comfortable, make sure nothing breaks in the front end. How do we sort of meet customer requirements? So this is the journey for the next 3 to 5 years, which if you can think about it, is a lot of resourcing and dollar spend from institutions. So actually, I think in the next couple of years, the conversation is moving away not from why should we do this as to, okay, we want to do this, but are we ready as institutions and whatever part of the value chain you're sitting in. So that's really, to me, one of the bigger constraints in implementing some of these, but yeah.
So I think some of the biggest obstacles right now is still regulation. What we need is a race to the top, and we need responsible jurisdictions like MAS building licensed regulatory frameworks where responsible actors can be supervised, build an aura of trust, and that's now starting to happen. I think we have to solve for liquidity, because you can't have utility without liquidity, which poses a very difficult issue with retail speculation and how do you protect retail speculation, which I think ultimately will be solved by TradFi, but TradFi I think is a little bit still, not leaning in yet. But I think those are, and then the public perception, sort of, as you said, sort of what are the headlines that are people reading?
Yeah, for us, we spent 2 years, working in Project Guardian, and we think we have the tech that we need to have actual global capital markets. And some of us, like SBI, we are kind of lucky because we pretty much own the whole value chain. We have the buy side, sell side, broker dealers. But at the end of the day, we still cannot do all of this at a scale. The main reason being that is not regulatory alignment between jurisdictions. Even though in the case of Project Guardian, we've been working very closely with Singapore, Switzerland, and Japan, we still ended up with bilateral agreements between UBS and SBI, UBS and DBS, you name it. That's not a scale. We cannot afford to do that, to do a single trade, which, by the way, was probably for us the biggest trade ever, $1 million plus, which is what we spent working with lawyers to define the risk control. So for me, the main point is scalability, right? We are doing all of this out of a profit center. I want to commercialize it. But due to the lack of alignment between these different jurisdictions, I just can't. I cannot afford, again, to end up with a 50 pages contract to do a single trade. So that is something that we are working on with the regulators and all the stakeholders. But unless we can take care of that issue, those of us who understand what it takes to do it, we simply cannot do it because there's no business case behind it.
Yeah, that's a great point. I mean, I guess the question is realistically, what are the prospects for regulatory alignment? It seems pretty hard. I mean, it seems like we're very, very far from that.
I'm cautiously optimistic, and sorry, Prady. Last year, when we started, it was just the MAS. They were pretty lonely. But this year, we have the GFSA and FEMA involved. And the FCA announced that they were joining this effort 2 weeks ago, right? Yeah. So at least I now have someone that I can talk to. Not only that, it's a regular coming to us, which I think that's a really good development. It might take a while. We'll keep pushing. But 18 months ago, that was not the case. MAS was the first, and again, it just was them for a year. But, I think we are getting there.
Just to turn to a totally different topic for a moment. So we've spent a lot of time talking about like digital asset tokenization. We can argue about what that term really means, but obviously there's a lot of other things out there. There's stable coins, central bank digital currencies, and I guess I'm just curious if you sort of see a world where sort of all these things kind of coexist, specifically central bank digital currencies, because those are pretty controversial. Some people think that they shouldn't exist at all. Let's start with you, Stuart. What do you think? I mean, why does anybody need a CBDC?
Well, I think there are certain countries, and we partner with certain countries that don't, we'll start there, that don't have sophisticated central bank infrastructures. And they're looking for a way to digitize currency that they can actually use. So whether that's Palau or Montenegro, that's where this stuff is being incubated. If you think about the United States with the central bank digital currency, that raises a whole host of issues with privacy, yep. Et cetera. So I think right now, countries are experimenting, and again, if to the extent you could create efficiency and opportunity, why not? Why not experiment? Stablecoins, I think, can coexist with CBDCs. Crypto, I think, can coexist with stablecoins and CBDCs, and tokenization of a real-world asset can coexist with all three.
So just, I mean, I would frame it as retail and non-retail
Yeah.
use cases. Too much of the narrative in the media is primarily focused on retail, whether it's crypto, whether it's CBDCs. And I mean, I mean, we leave it to the governments to decide whether they need a CBDC solution. I mean, India's done $1 billion plus payout into bank accounts without a CBDC, right? So I think, you know, there's mechanisms to achieve this, but you're right. I mean, there are countries which don't have the infrastructure or the ability to get there, and maybe there's an angle for CBDC, but there's a massive privacy issue with that. I mean, where we get excited by is on the non-retail use cases, where in a fractional banking system, you do have a role of the hierarchy of money, or just sort of how you look at credit creation, and you know, we do think commercial banks can need to play a role in that context. So, so central banks do need to play the role. As downstream, there's modernization of the infrastructure and the solutions. You do need central banks to then provide some solutions. Now, whether that's a wholesale CBDC or that's a 24/7 RTGS implementation, and if the normal thing takes 5 years, that's probably like 5 to 10 years.
Yep.
So it's a complicated topic. I think it's got more to do with downstream usage models, and it goes to the core of what, Emily, you're trying to drive in this panel, which is, I mean, definitely the end customers are asking for these functionalities, which we think then results in pressure upstream, such that central banks say, okay, now there's a business case. Thus far, the reason you're not seeing a lot of movement is beyond a few countries where domestic payment systems are not evolved, there isn't really an economic case for a central bank to say, let me go issue a CBDC. And I think that business case is strengthening year by year now, in which case, you know, we do expect some movements. And again, it could be RTGS integrations, which we think is more logical. Obviously, if, you know, certain central banks want to go with a CBDC, then so be it.
So in our case, as someone who's building a digital capital markets ecosystem, what I need is a settlement token. And I don't think we need to wait until this debate is settled.
Yep.
As long as the stablecoin is properly regulated, they have a CDBC, again, it's probably regulated by definition. From a position as a consumer of that utility something, we don't have an issue as long as this is properly regulated. So, and there's a lot of noise about that, but as a practitioner, in a way, I don't care, as long as the semantics and the legal framework is in place.
I don't know if you have any thoughts about it.
Yeah, I have lots of thoughts about it. I mean, look, I'm somebody who would put a lot more trust in the private sector to get these like digitization of payments, et cetera, right, in a way that's going to ultimately be more efficient and trustworthy, and not have to worry about all kinds of concerns around privacy. Because when you have, if you have a central bank, for example, that's involved in retail,
Yep.
wow. I mean, the level of control that central bank can exert over its population is pretty mind-blowing from my perspective. I think a lot of central banks like RBI, Brazil, have done a remarkable job with real-time payments and building out digital public infrastructure in a way that's really exciting. But it's, for the most part, it's the fintechs that are driving mass adoption and distribution. So you have to have that power balance between the two. But I don't think that you want the same entity that's controlling monetary policy, which is an important functionality, to also control and understand and know how I see, spend, et cetera, my money. And I don't think it's necessary. I'm not sure. And then with CBDCs, you have this you're going to have this whole problem if they develop around interoperability. So again, I think there's a lot to be said for
Yeah, and I think you're
the
right.
private
It's
sector to
important
be a big
to
player.
separate retail and wholesale. So quickly, we have like a little over a minute left. Obviously, maybe we should put Singapore aside from this conversation, but generally speaking, do you think that the current sort of regulatory structures that we have right now in the world are adequate for regulating this industry? Or do we kind of need to like completely, I don't know, redo it?
I think we're getting there. I mean, I do think the countries we listed before, I think what we're seeing in the UK through the FCA, I think what we're seeing through MICA or MICA, depending on how people pronounce it differently, I think what we're seeing in the Emirates, I think what has been accomplished in Japan, I think they're getting it right.
Any other quick? Yep.
I think until regulators more regulators can interact and understand the technology, they're not going to get it right. So once you have a shift, then you're going to have something. I mean, today in the U.S., you ask a regulator if their only option to get a football ticket was to get it through an NFT, they're probably going to opt out of going to the game. That's a very basic problem that we need to solve for, because until you understand it and interact with it, it's going to be very difficult to make smart decisions around it.
So what I think is that we're finally reaching the critical mass of regulators who are sophisticated, and they're going to be challenging you, right, to make this happen. I would call such regulators crypto-friendly, as opposed to crypto-easy, right? I think that's a big difference. So, and crypto-friendly, the likes of MAS, Japan, Switzerland, I would call crypto-friendly, but others that all of us know who they are, I would call them crypto-easy, as opposed to crypto-friendly.
Yeah, so Singapore's clearly got the gold medal from this panel with overseas guests. So going beyond Singapore, what we are finding is regulators are being responsive. It's still, we must remember, a small part of the market, which is evolving and moving. Outside the US, we are definitely finding engagement across multiple jurisdictions, which is evolving and moving in the right direction. And this is hard work. It's going to take time.
Okay, well, we're at time, but quickly, can Singapore regulators interact with crypto? Are they allowed to? I mean, because...
I have no idea. I'm not a regulator. You should
I
ask
don't know. It's an interesting question to prove your point, right? Because, like, I don't know if Singapore regulators are allowed to do it, and it hasn't stopped them from being open.
Not privy to their policy for holding digital assets.
Look, what you need to know, I don't want to say what Singapore regulators can when I'm in their home, but what you need to know is that in Singapore, they put out this Project Guardian, right? They really understood that if you're going to make rules and standards, you have to participate.
Guardian,
and that's amazing.
I think the key is that they could use DBS as the proxy. That is the point. I would like to ask the US regulators, hopefully there's one of them here, why don't you let JP Morgan, Citibank do it? That's the proxy that you need. I don't think they need to get their hands dirty. They can let the bank do that and learn from them. That would be my piece of advice, my 2 cents.
Great. Well, I think we're at time. Thank you guys so much.
Thank you.